Good morning, everybody. Happy Thursday. We'll get started here in just a minute or two. Okay, let's get started. Let me just check here. And hopefully you guys can hear me okay. So thank you for being here on this Thursday. Apologies, there's noise out there. We'll hopefully will go away in just a minute. Let me just make sure I got my notes together. And of course, as always, if you guys have questions, please do let me know. This is supposed to be as interactive as possible. If you're brand new here, this is our new market morning show. It's supposed to be 10 to 15 minutes. One, maybe two at most sort of ideas for that are top of mind. Hopefully actionable as well. So let's get started. We have a non-farm payrolls number tomorrow. I know everyone's focusing on that, rightly so. I think it's important though to remember that a lot of times these big economic data points are kind of a nothing burger. Not always, of course, right? There are exceptions, but a lot of times they are. And so it's a media exercise to always be focusing on those data points because they need something to talk about. But in reality, again, they don't move things that much, but they can. That there's always that risk. So which then paradoxically, from a risk management perspective, does make these events important, right? Because we don't want to take the chance of something completely blowing the portfolio apart. So it just becomes a risk management exercise in terms of on the portfolio level, less so on the trade by trade sort of level, if that makes sense. So how does this play into tomorrow? What am I trying to say? Well, there's two things. The number one thing is utilities, and I actually made a little video on this as well that I think a lot of you guys are going to receive today. I came across this following chart here. Actually, let me first make a big chart so you can kind of see this in the big picture, and I'm going to adjust this just a little bit so that you can see this well. But the long and short of it is that utilities are, historically speaking, quite overbought right now. And remember, utilities are bond proxies, and this will matter. I'll tell you why. So if you look at utilities right now, they are the most overbought according to one statistic that I'll show you in a second since the year 2000. So basically, since then, back there they were about trading about 20% above their 200. I think it's 200-day moving average, and that's more or less where they're trading right now. About 20%, the XLU ETF above the 200-day moving average, roughly speaking, right? That's roughly kind of where we are. Why does this matter? Why do you even care about utility surge? We care about this because if we have a non-farm payroll number tomorrow that were, let's say, a little bit stronger than expected, or maybe much stronger than expected. I just hypothetical, I'm trying to walk you through this. This could sort of reverberate through the market, because if that's the case, then the Fed is likely not going to be able to cut rates as quickly as the market's expecting, at least data point by data point. If that's the case, then that means that interest rates are probably going to go higher, and inflation expectations are going to go higher, which means that bond prices will go down, and the equity market, quite frankly, will probably not like it too much either. Although the equity market might be okay either way, but it'll probably take a bit of a step back, right? One step back, two steps forward kind of thing. So then maybe we could see that early October weakness that we've been talking about here in this form over basically week to date. That's this chart here. Let me see if I can. Here it is. I'll bring it up one more time here this week. That's this early October potential weakness. Remember, it's only October 3rd today. So that is what could potentially transpire. So now the reason why that's important as far as utilities are concerned is because utilities could then mean revert a little bit. So here's the chart that I came across this in Twitter in full transparency. And you can see we're essentially, the data point that I want to point out is that we're 20%, utilities are trading 20% above their 200-day moving average. And that has only happened once before, according to this statistic. That one was back in the year 2000. And then it lasted for 1 day. And then utilities basically came back down. So you can learn a lot by looking at things through a cross-asset lens. So I think this is interesting to watch for market participants. Now, if you're wondering if there's a trade, sir, just give me a damn trade. I don't have time for all this other actual analysis stuff. First of all, it's a dangerous attitude to have, so please be careful. But if there's one bet to make in such a case, it would be maybe to put on some sort of maybe an options credit spread where we would make the bet that, let's say, the utilities sector just doesn't ramp much higher from here. So we could put on a bear call spread, as it's called, where maybe utilities don't go a heck of a lot higher from here. But again, one would be making that bet then into this non-farm payrolls number. So to me, this is the kind of thing I prefer to put on after the event is over, so after the data point. But again, utilities are very, very stretched here, even just by the simple analysis of the eye. And you can kind of see it's played out pretty well. Like if you just want to draw some lines on the chart, like I can show you this. It actually has behaved very well. Let me use this thing here. So you can kind of see we had this initial move higher off of the higher low in February. Then we paused, and then we had another move higher that's measured almost exactly the same. So again, this is like kindergarten stuff, but it tends to have worked pretty well. So from that perspective, we might also be a bit overbought. So how does this all play into things? Well, let's take this. This is the first and second derivative. Let's go into the third derivative of this, right? So we talked about utilities being overbought. We'll show you the statistic, potentially, how this would play into non-farm payrolls. Well, if the jobs number is better than expected, and again, I'm just trying to be hypothetical, just kind of think this through. This is the conversations I have with with our family office clients throughout the week. Then utilities would go down, which means bond prices go down, which is a result of bond yields going higher. Or if bond yields are going higher, they're probably going higher in part in this situation because inflation expectations are going up. If inflation expectations are going up, then that would be bullish for our inflation theme that we've talked about. So things like copper, CPER, which I continue to point out, and again we've got some news on this coming out soon, should ultimately do very well. Remember, copper, a key ingredient in the electrification of the world. And just an inflation, if you want to not get your butt handed to you by inflation, we want to own things like copper. I'll show you copper futures. CPER is an ETF, a US listed ETF for that if you're a global investor. There are other ETFs for that, but this is what copper futures look like. So this is not bearish, right? It very much looks like the energy sector, not surprisingly. So that's how you kind of think this through in our view. So, from a portfolio perspective, we want to be long things like copper. We want to be long hard assets. We want to be long, basically have almost an inverse portfolio construction of how most people are right now. Most people are way over their skis in terms of tech. Tech is not bad. Tech is good. But if we see a mean reversion trade, which is almost always happens, actually it always happens, portfolios could be in serious trouble. So why not diversify away a little bit from a massive over allocation in tech, right? There's nothing wrong being long tech. The problem is the time frame. Tech outperforms over the long term, 10 years, but it doesn't have to outperform over the next 2 years or the next 5 years, right? And that's a long time frame for a lot of people, particularly baby boomers. So that's as far as that goes. So those are kind of my two thoughts here as we head into this Friday non-farm payrolls. Again, it tends to be a little bit of a nothing burger, as I said before, but I think and I hope this is helpful, by the way. I want to just take a minute and kind of walk you guys through how we see something like this playing out, kind of what the thought process looks like on something like this, right? So, how you can take something like utilities and then extrapolate that into a non-farm payroll. Want to talk about two more things that we've touched on here before. One of them is general dynamics. This was actually in our inaugural, in our kickoff session of these daily or Monday through Thursday YouTube shows. We talked about general dynamics. We talked about how it could hold up relatively better than some other things. It's still holding in there. It hasn't broken out like crazy, but it's holding in pretty well. So I would say that's a check mark. And then we have Apple, which we talked about being in a situation where it's just unlikely to blow higher immediately from here. It's likely in some sort of a consolidation phase, which is typical from a seasonal perspective, meaning after its iPhone announcements, it typically tends to consolidate. And then I actually sent this chart out yesterday as well. I don't know if you guys have seen this yet, but this is a monthly chart of Apple that might be interesting. This is just kind of like add on to, again, something I mentioned here last week or the week before, I believe, in this morning show that we're running here. And I pointed out that since the year 2000, Apple typically has started to run out of steam after 5, at the very most 7 monthly increases. And so we're now in the 6th month. And, when I say running out of steam, I mean like just pausing, right? Not falling off a cliff. But that is potentially in the cards here for Apple as well. As always, please give us a thumbs up. Please subscribe to the channel, because if you don't and the algos don't pick it up, then at some point we're going to have to shut this show down because it just won't be worth it. So if you could do that, that would be awesome. Also, tell people about it if you find this useful at all. Again, 10-15 minutes going over some important points. Lastly, if you don't have a YouTube account, I would urge you to create one, because it allows you to be updated automatically when this show airs, so you get like a pop-up on your screen so that you don't have to worry about getting an email link or something. It also has the added benefit that when we upload like a new podcast, so for example, yesterday, shameless plug, I interviewed, once again, our second interview with him, Brendan Ahern. I interviewed the manager of the K-Web ETF. So that podcast, I recorded it yesterday with him, is going to air probably on Monday, this coming Monday. So if you don't want to miss that, once we upload it to YouTube, you will automatically be alerted to it once it's uploaded. You don't have to then go search and send us an email. It'll automatically be on your YouTube stream. So again, thumbs up, like, please, and subscribe. That helps us. Otherwise, again, we will have to shut this morning show down, and because it just won't be worth it, So anyway, thank you so much. Again, if it's helpful, please share, subscribe, thumbs up. It helps us with the algos picking up the show. It just allows us to be able to continue this show. So thank you so much. Have a great weekend. We remember we do show Monday through Thursday. So we'll see you again back here on Monday. Have a great day and a great weekend, and we'll see you soon.